Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, folks, this is the final video for the week. I just want to reach out to you if you've been watching this channel and haven't subscribed. We're 100 subscribers away from 20,000. I've grown this channel completely organically. You folks have followed me through YouTube and other methods. I really appreciate all the enthusiasm around the channel. So go ahead and subscribe and like these videos so we can actually move the community further along. As we look back at yesterday's action, in the previous video, I talked about will the market roll over, and it was a question mark. And there was a key number in that report last night that discussed what was the critical element for the market to roll over, and that was a close under 33.60. We did not get that close. We opened lower. We traded down to the STX number, which is the extreme on the market grid. If you haven't seen the market grid, it's posted in the community section every night, but I also show them on screens later in the technical section. We opened lower. We traded down to the 33.54 level and then bounced sharply off of there. It was led once again by the mega tech stocks, which was the Apples, Microsoft, Google, Facebook, Amazon, and Tesla. So they led the way. Markets were screaming on the upside, especially in the NASDAQ, finishing up over 1%, with the Russell finishing lower and the S&P just finishing up 0.3 on the session. The leadership situation I've been talking about for a number of weeks is being challenged. Once again, the spreads have moved back toward the all-time lows. As we go forward, there's still something I've been talking to you about, and it's continuing to happen. The internal trends inside the markets are continuing to deteriorate. I'll go through in a few minutes of our database, which we saw another 1,600 sell signals, and I've been telling you that the key number on our short-term database will be 68%. Well, we are now below 68% as of tomorrow morning on the open. And I continue to expect to see further liquidation in our database. The other situation that continues to evolve is the stocks that I mentioned, every one of them appear to be in a fifth wave rally and are approaching some sort of major high. I'm not saying they're currently at a high, but they're approaching a major high. The rotation in the database is telling us that the underlying trends are deteriorating. One of the strong parts of this market has not just been those stocks that have been rallying that I just mentioned, but also in the backdrop, there were almost 13,000 symbols that were also in short-term trends. This deterioration is going to have a material effect at some time. Now, whether it's a high-level consolidation or whether it's a short-term top or even an intermediate top that forms somewhere around these levels. As we look at the fundamentals, in yesterday's report, I talked about the expectation for the employment claims, and they came in a little worse than expected on a weekly basis, but the continuing claims, which is a number I've been telling you to watch, came in under 15 million at 14.8 million. This was a positive number, and that also triggered some positive sentiment after the market opened yesterday. Today, housing starts will be released. I'm expecting to see them come out better than expected, just like all the housing numbers that we've seen earlier this week. This is likely to continue to evolve as the big movement out of the urban areas continues out into the burbs. There's one more thing that we need to discuss before we end this week. Next week is a giant party in Wyoming. The Jackson Hole gathering of all of the central banks is going to be happening. Just imagine the conversations that are going to be going on at this party. This is going to be a major event. The last time that we were in a situation like this was way back in 2011 when we had the European crisis. That was also an interesting point in time. It wasn't the Jackson Hole meeting. It was a coordinated effort. Within 14 days, they moved the market meter approximately of 14% in October of 2011. As I've discussed with you before, it's not just the central banks, it's the governments. This is a team right now. They're in the process of restructuring everything financial in the world. I've talked about this before. Universal income, all types of things are likely to come out of this environment. But for sure that the governments are going to be participating as well. I suspect There will be matching programs on both sides of the equation from the monetary as well as fiscal stimulus. They're not going to let this opportunity go at this point. They're going to continue to restructure the economy, the financial system, including society as they go forward. And this is a coordinated event between not only the central banks, but all of the governments involved. The odd man out is China, but they're already doing the same thing internally. So everybody on the planet is playing the same game. It's all been triggered by the coronavirus, and it's given them the opportunity to take control of virtually everything. And as I mentioned when we started this whole situation back in March, that we would not come out of this the same that we went in. Recently, I discussed that I think some things are going to be better than they were before going in this, but for sure, everything's going to be different. As we get to next Friday, we're going to have a glimpse, I think, into this forward-looking world. They're going to be pushing everything forward with huge structural changes, both in the economy and society. Get ready. I think we're going to have a glimpse into the future. Let's go ahead and take a look at the charts, see what they're telling us for Friday, see if I can see any insights on what might occur as we begin next week. Reviewing the WaveTech database, I've been discussing over the past 2 weeks that I expect to see the short-term database start to liquidate, and the key number was at 68% bullish. In today's run, in spite of the strength that we saw in the S&P, there's still a substantial amount of selling going on in the short-term database. And the reason why this is happening, as many stocks very extended and overdone, and they're going to move into a correctional phase, as I've been discussing, somewhere between 2 and 6 weeks is the length that I'm expecting this event to occur. Now we dropped below 68%. We're at 67.56, but between the two models, 1.2 and 3.2, we saw 1,652 sells versus 170 buys, giving us a net sell of 1,482 symbols. This liquidation is going to continue, as I mentioned, expecting to see it down toward the 42% level over the next several weeks. And depending on what type of action we get, if we get some downside in this market, we're likely to see this accelerate toward this number. In yesterday's video, I covered our VPM, which is the Virtual Portfolio Manager Universe chart, and this has the average price about 6,000 stocks in the database. This chart goes back to 2001 and goes forward. And what I want to point out here is there's something very interesting that's going on. In spite of this very sharp rally that we're seeing, we're a long ways from making a new high on this index. One of the things that you'll notice here, there's definitely an impulse type wave pattern going back and looking at the 2003 up to the highs in 2007. The current pattern is a very corrective pattern. The reason why I'm talking about being corrective is that each one of these highs here are being overlapped, that the next low overlaps the previous high. Over here, this did not happen. We did not see a previous low overlap a high. So this is the difference in the structure of the market. Not only in the structure, we're a long ways from getting up here and rendering a new high on this chart. This is telling me there is a lot of work to do before this market will be ready to make any kind of big new wave up. Now, we've been talking about for weeks on end that the S&P was going to make a new high. It's done that now. Not only is this structure different, but this is a non-weighted environment, which gives us a much different viewpoint of the world. And this is not a bullish chart. The fact is that we're living in two different worlds right now, the tech world and the old world. This chart is basically everything, but because it's not a cap-weighted index, you're not going to see the same type of configuration you're seeing on the NASDAQ. So this is a different view of the world from the standpoint of price structure and trend structure that's going on. This whole rotation that I've been talking about in the markets has got a lot of work to do. Beginning with the daily S&P cash, I mentioned this in the opening comments, but yesterday's low was 3354.69. The STX number, or the extreme projected low, was 3353.79, and then the market rallied all the way to S3, which is 3390.94, with a high of 3390.80. A perfect hit on STX and the R3 number yesterday. The other thing that is continuing to happen is that 3-day vol number is continuing to increase. It's now at 30.30. If you recall, just 2 sessions ago, it was at 16.84. So this is a big expansion of volatility, and this is important from the standpoint of what we're likely to see from the structures of the market. Now, the S&P futures has been trading positive all night. This video is getting done a little later tonight. It's about 20 minutes after the London Open. We're starting to see some selling come in. The futures just went to negative values after being up about 10 handles plus earlier. The rally that occurred yesterday was triggered by these large cap tech stocks pushing all the markets back up off their lows substantially. I mentioned in last night's video that the key level was the 3360 level. So today, the key level is going to be 3370.42. That is the 10-period moving average. The PPM 1 is at 0.11. This is important because this now says that there is a 60% probability that this 3370 level will be penetrated and that we're likely to close below this level. That suggests then that we will start a decline toward the 3320 to the 3307 level. The fact that we rallied yesterday does not mean this market's just going to go directly to new highs. As we look at the market grid for the cash today, 3392.67 is R1. That's also the old high was 3393 and change. And so far, we have not closed above that 3393 level. Yesterday's range, 3390, we closed at 85. We have not closed above 3393. This market is still vulnerable to some downside, and especially with these PPMs continuing to decline. If we do get above the 3392 level, then it's an automatic test of 3400, possibility of going to 3408. So these are very tight numbers for the pivots for today, but the big number will be 3370 level. That's also the S2 level. Breaks through S2. There's a setup for a retest of yesterday's low at 3354. It still appears that there's a lot of potential downward pressure in this market right now. Not just the liquidation of our database, but from the PPMs and other factors are starting to weigh on this market here. As I discussed in last night's video, I don't see much below the 3320 level at the moment. There is potential for a larger correction to unfold, and I threw out a number last night of somewhere maybe as 4 to 8%, and that's still a possibility, but that's still not a very big sell-off. As I also mentioned in the opening commentary, that many of these large stocks, I'm not going to cover the Apples and the Amazons and the big high-tech stocks, but many of those are in absolute fifth wave rally where they might end, could be at any moment. It could be 2 weeks from now, it could be 2 days, it could be today. But the point is that we are coming to an end of that big rally that we've seen, and then we're going to see a larger correction phase, and that should set up the whole database scenario that I'm talking to you about. And ultimately, this is going to recycle. On Sunday night, I will cover the intermediate database, which will give you what's going on in the longer term trends. But on the short term trends, it seems very clear there's still a potential for a downside. The extreme to the upside now, as you look at the market grid for the cash, is the 3400, 3408, and the extreme is 3415. Doesn't look like there's the type of momentum that we need to push this thing into a new high and even get a close over the 3393 level. Reviewing the NASDAQ futures. So far in tonight's action, we've seen a low of 11,466. S1 is 11,433, so we come just short of S1. R1, 11,521. The high so far, 11,524. Basically got an R1, S1. What I'm expecting to see here is that an S2 hit, possibly an S3 on the downside. If we get through in a material way, 11,521, then the next resistance, 11,571, 11,620, with an extreme 11,664. Now, the NASDAQ, as I've talked about over and over, this has a much different profile. 11,235 is the 10-period moving average. The PPM1 is at a 0.32, which says there's only a 30% probability to decline below that number. So it continues to be that the NASDAQ has much stronger support than the S&P, and we might see further negative rotation on that leadership that I've been talking about for the past several weeks. So key numbers on the NASDAQ again, 11,433, we're trading 11,466. If we get through that level, then 11,383 S2, possibly an R1 S2 type range for the day. The final market will be gold. It just turned negative on the session. The S1 number is 1934. We've had a low of 1943. On the upside, the high has been 1963. We've traded just between R1, R2 on the session. The key element to watch here that I mentioned last night is that PPM1 is at a minus 0.41, which indicates that the gold market is in a short-term negative trend and is likely to continue down toward ultimately that 1919 number that I discussed in last night's video. There's not a lot of upside in this market right now. As I've discussed, I believe that the trends are broken and there's going to be a multiple week consolidation. This is most evident when we take a look at the weekly graph. As I've been discussing for the last 2 weeks, I think there's just going to be a very broad range. We did trade up to 2024 this week, and the low was 1928. We came just short of that 1919 S1 number that's down there. So we basically traded an R2 S1 this week. It's probably, for the most part, done, but we could see a retest of that 28 number and maybe see 1919 printed today. The next number under there is at 1886. The other major number that's in this mix is the 10-week moving average. 1887 corresponds exactly with the S2 number is at the 1886. When we come into Sunday night's video, these numbers will be updated, so we'll have a better feel for expectations. But that 10-week moving average is moving up about $20 plus per week. So that's going to throw us right at 1900. So the expectation on the downside, extreme support, 1920 to the 1900 level. That's a pretty good buy zone for a trade off of these levels. But overall, the next 3 to 4 weeks are going to continue to be in a very broad range of 1920, 2050. This will complete the video. Thank you so much for watching. We had another great week. I hope everyone has a great weekend. I will talk to you on Sunday night. Thanks again for watching.